Hello and welcome to the September 2022 Economic Report from advancedprojections.com. Here's our review of August's economic data highlights before we get into our projections and detailed review. Employment figures for August came in with a still solid new jobs figure up 318,000, but unemployment still moved up to 3.7%. This now confirms what we have been predicting every month since our January report, that unemployment would dip to 3.3 to 3.5%, as it did hit its low of 3.5% in July. Unemployment should now begin to gradually move upwards. These levels will still keep the Fed fully focused on inflation, as confirmed by Chairman Powell and other Fed governors. Second quarter 2022 had productivity down again with a significant decline of 4.1%, revised from 4.6% down. This added a small amount of fuel to the debate over is it a recession or isn't it. Technically and officially, it isn't yet, but this productivity decline, along with the whopping 7.1% decline in the first quarter, is telling us that we are paying a larger gross national income for a slightly shrinking GDP. This is clearly not sustainable. Annual inflation through August was announced on September 13th with consensus expectations for it to be about 8.0%. The actual reported value was 8.3%. This was within our expectations, as we had expected to see an 8.3 to 8.8% figure for August. September's figure should also fall within that range. As oil and gasoline prices stabilize, electric and gas utility costs have risen dramatically and will likely continue to do so for the remainder of the year. Equities markets gained a few percent in August, but gave back most of those gains in early September. With the inflation figures out on September 13th, equities resumed their downward trend with a particularly strong move down on that day. Our indicator system moved our recession risk level up from 80 to 85% last month due to declining leading economic indicators, a very hawkish Federal Reserve monetary policy stance, and newly yellow APFD and APYC, those are Fed and yield curve indicators. There are now no AP indicators in green territory. So we repeat the 85% probability of recession for this month. Now, just a quick quote that we published first last month from Thomas Barkin, president of the Federal Reserve Bank of Richmond, July of 2022. He said, quote, "There is a path to getting inflation under control, but a recession could happen in the process. If one does, we need to keep it in perspective. No one canceled the business cycle," unquote. So here are the current underlying economic details. Year-over-year consumer price index increases and supply chain issues have continued to plague many aspects of the economy. These have been keeping prices and inflation expectations elevated as demands for labor and materials remain above available supplies in many industries. In our June report, we said, quote, "Everyone should expect at least a few more months that are in the range of 8 to 9%, unquote. Per that projection, the June inflation number came in hot and high at 9.1%, and July was 8.5%. General expectations out just ahead of the August announcement were for 8.0%, but it came in above that at an unacceptably high number, 8.3%, right within the range we were expecting. Following a 1.5% real GDP decline in the first quarter, the second quarter came in a tad lower than was generally expected, also down at minus 0.9%. Common understanding aside, these two consecutive quarters of real GDP declines lacked the breadth and depth that the National Bureau of Economic Research looks for in declaring a recession. However, underlying those declines were the significant productivity drops in those same two quarters of minus 7.1% and minus 4.1%, respectively. Elsewhere, we have written about how the NBER makes their recession starting and ending determinations, which come with recession declarations well after they have begun. So these declarations are helpful only in a historical context. But for investors and business planners, they need to have a better system of recession leading indicators, and that would be our advanced projections system. The Bureau of Labor Statistics employment and Federal Reserve's intentions are reviewed here. Unemployment remains well below 4% over the past 8 months, now just up slightly from 3.5 to 3.7%, with new job gains in August of 318,000. We expect those gains to continue for another few months in a restrained and declining fashion. Since the beginning of the year, we had seen others project that unemployment would reach 3.7% by the end of the year. As we have been stating since January, our own figures fell into the 3.3 to 3.5% range, and we reached that last month. We are now expecting a gradually increasing trend in unemployment, beginning around this month's 3.7%, and up to as much as 4.0% by the end of the year, as major retailers start dialing back their expectations for the holiday season. There are still a bit less than 2 job openings being advertised for every unemployed person who is looking for work. The workforce grew a bit as more people entered or re-entered the job market. Inflation may be the motivating factor for a significant portion of those re-entering workers. We include the typical table from the Bureau of Labor Statistics, which shows the employment situation at the end of August, with general improvements in the employment picture we have been experiencing over the past 3 months, and also as compared to 1 year ago. That's the Household Data Summary Table A, which is in our written report. The current solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their rate increase script, as well as in their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so along with their March, May, June, and July rate increase announcements, and within their latest available FOMC meeting minutes. Look for increased activity in these areas when the Fed returns with their next steps to be announced on September 21st, which is just next week. The FOMC's July meeting minutes and Chairman Powell's Jackson Hole speech last month confirmed that the Fed will be data-driven and resolute in their efforts to bring inflation back to 2%. Via a program composed of rate hikes and money supply contractions, which are also known as balance sheet reductions for the Fed. Within the July 27th Fed FOMC interest rate hike explanations, we read a continued expectation for another 75 basis point bump for this next rate increase in late September. But with the new CPI figure just out, it may be as high as 100 basis points and will be announced on September 21st. There was a 2-month gap between the FOMC's July and September meetings, and there will be another 6-week gap until their early November meeting. So they are not likely to approach this increase delicately. Third quarter 2022 corporate earnings expectations have been set lower by corporate finance departments. However, the number of companies who came in below expectations has increased above the normal proportions seen in these quarterly summations. Multiple retailers also warned of a need for heavy discounting in the third quarter to clear accumulated seasonal inventories. In the second quarter, outside of the energy industry, all sectors reported declines in earnings growth. We have a chart and a quote from FactSet that was issued on September 9th, which very clearly reveals what mainstream companies are expecting in the months ahead. These expectations were also confirmed at a recent investor conference sponsored by Goldman Sachs. But we expect third quarter growth in earnings to be zero or negative as well. So take a look at that chart in our written report. Here is the FactSet article quotation. We searched for the term recession in the conference call transcripts of all the S&P 500 companies that conducted earnings conference calls from June 15th through September 8th. Of these companies, 240 out of 500 cited the term recession during their earnings calls for the second quarter, which is well above the 5-year average of just 52. In fact, this is the highest number of S&P 500 companies citing recession on earnings calls going back to at least 2010, using current index constituents going back in time. The previous record since 2010 was 212, which occurred in the first quarter of 2020 at the start of the COVID-19 pandemic. By way of comparison, 412 S&P companies have cited inflation on Q2 earnings calls, and 325 S&P 500 companies have cited supply chain on Q2 earnings calls. And that's the end of the article quote from FactSet. June and July 75 basis point interest rate increases have already had a significant effect on the price of oil, driving it down about 25% so far and hitting energy exploration equities hard as well. As we are facing further significant rate hikes, this is very likely to be a continuing trend downward, with oil potentially back below $80 by the end of the third quarter 2022. Look for replenishment purchases for the Strategic Petroleum Reserve to begin later this year, temporarily supporting prices. Other major sources of energy, namely natural gas and electric power, have not declined at all in sympathy with oil. So those entities that do not rely on petroleum will be paying significantly higher utility bills for the remainder of the year. Natural gas prices will soon end their bit of a breather due to a fire that happened at the Freeport, Texas export facility when it returns to service in what they now claim is going to be November. That will also keep electric power production costs high, as natural gas accounts for about 40% of the U.S. power generation mix. Several new liquefied natural gas facilities are under construction, and their export activities will keep upward pressure on natural gas prices and hence electricity as well. High natural gas prices have stimulated a renewal in well development, and there are now more drilling rigs in operation than there were in late 2019. We expect high natural gas prices to persist as long as Putin tries to hold Europe hostage with restricted natural gas supplies. In equities, in July, the S&P 500 broke back upwards from its June low and closed the month of July around 4130, the same as it closed out April and May. That meant it was back solidly into bubble territory, and moves made between July 31st and August 12th put it another 140 points higher. We expected resistance to set in around those levels based upon a simple index chart reading, but a turnaround in market sentiment would depend heavily on some kind of negative news that would counteract the so-called good news from the very slight decrease in inflation for July, the cause of the most recent surge in equity prices. As we fully expected, inflation was reported to be alive and kicking on September 13th, so there's the counteractive news we were looking for. The markets responded quite negatively, all major indices down in the 4 to 5% range within one day. Now, we should continue to expect significant further declines in equities and bonds. A return from the current index level just below bubble territory to warm market levels would take the S&P down to about 3650, and a correction to the mean would be near 2900. In a typical bear market, negative investor emotions carry enough downward momentum to drive indices significantly below the mean, towards and through the inevitable retail investor emotions of despair and capitulation, when finally the selling ends. There is no current reason to expect anything different this time, as the Fed appears to be highly resolute in their attack on inflation, and that means more significant rate hikes are expected soon, beginning with the next one on September 21st. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and for breakdowns in this metric which appear ahead of real economic downturns. Margin borrowing, which finally moved off of its historic highs in the first quarter of this year, has in the month of June collapsed by 9.2%. In the second quarter, it was down a massive 15%. And it is still down a total of a bit less than 25% from its last peak in late 2021. This is continuing evidence of something that is seriously discouraging many risk takers from borrowing to finance equity speculation. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.